Welcome to part 3 of our 3-part market update. In parts 1 and 2, we covered the global economy, the consumer, and the changing jobs market here in the US. Here in this third section, we're going to talk about stock markets, which are hitting new highs, and the Federal Reserve and their path to rising interest rates. We hope that you find this information valuable, as a lot of people are feeling fear over the rise in stock prices. Welcome to the third and final segment of this 3-part market update. In parts 1 and 2, we reviewed economic growth, the consumer, and the status of the jobs market here in the US. We will now discuss stock markets, including valuations, recent returns, and where we stand relative to long-term trends. We will also review the Fed's recent rate hikes and how those changes might impact the economy and the stock market.
So as we take a look at the stock market and the bond market as it relates to interest rates, it's always important, we think, to look back and see how things have been doing. So this is as of the end of June. When we look at the year-to-date numbers, they're all pretty phenomenal. And even the bond market with rising rates this year, that's the Barclays US Ag, even it's positive. I would point out that moderate allocation is actually the Morningstar database of mutual funds that are 60% stocks, 40% bonds. So that tends to be a little lower in the return department, but it also tends to have lower potential volatility. Notice that the trailing 12 months are highlighted by the tech-heavy NASDAQ and also the small-cap Russell 2000. And we also think it's important to note that EFI, that's 2/3 Europe, 1/3 Japan, has had a pretty dramatic recovery in the past 12 months. Still lagging over the longer term, but we do think that might bode well for the future in those particular markets. One of the things that people have said frequently is, we're at new highs. This bull market has been running for a long time. We think it's important to put that in perspective. So yes, it's been running about 6 years or so, or 8 years at this point. But notice there's other periods that have been equivalent or longer. And we always want to remember that investors pay for earnings. And just because we're at new highs doesn't mean that we're have a correction. Now, we will have corrections, but so far we are at new highs for the right reasons. The other strong message we've been trying to send for a couple of quarters now is the trend is your friend. This is a couple of different longer-term trends of the S&P 500, one of them with dividends reinvested. As you can see, we were lagging trend for a while. We've now caught up, maybe slightly ahead, but the point is that with the trend being your friend, that's a good positive thing. And now we want to take a look at what earnings might be doing for us as well. And as we reminded you, and you've seen this slide numerous times before, investors pay for earnings. Now, sometimes they pay too much for earnings. If you look at that period in the late 90s, the black line has significantly higher than the orange-colored line, and that's a bubble. But what you can see now is that we've been tracking earnings and the projections for 2017 and 2018, if they come true. Yes, we're a little ahead of that right now, but it does look like we could maybe end up with even a more positive outcome on those earnings estimates. So the important thing to be watching is the earnings that are getting reported. We're in the middle of earnings season right now here at the end of July, and we are watching that very carefully to be sure that those estimates continue to ring true.
One of the questions we're receiving a lot right now as the Fed makes headlines and rates are moving up is, are these rising rates bad for the stock market? That's a very common headline. And I thought this chart helped illustrate why that may not be true. What you can see here is that the black line is the bond yield and the orange line is the market. And there are periods where the bond yields are rising and they tend to coincide with an upward moving market. And so our point here is that interest rates do impact stock valuations. There's some important relationship there, but just because interest rates are moving up doesn't necessarily mean it's bad for stocks. In the end, the Fed raises rates because the economy is strong, and a strong economy is usually very good for stocks, and we're seeing that right now. What's most important when we talk about the Fed raising rates and how the bond market's changing is something we call the yield curve. And you'll start to see this headline, I think, more and more in the next several months to the next couple of years. And the yield curve is basically the relationship between the more short-term rates that the Federal Reserve manages and the long-term rates that are very much dictated by market conditions and really by expectations of inflation. A steep yield curve where the short end of the curve is much lower than the long end is a good thing for the economy. It incentivizes banks to lend money, and it tends to coincide with high levels of economic activity. What we don't want to see is a flat yield curve like we saw back here in 2007, just before we hit the peak of markets and the Great Recession. And the fear here is that the short-term rates the Fed is increasing will start to move this curve more flat. Time will tell. There's also market forces at play in the long end that might move those rates up. And as long as they move at the same time, the yield curve can remain steep and we can remain in a growth environment for the overall economy. So when you hear things about the yield curve, just know that's what they're referencing, is this relationship between short and long-term rates. And it's just as unpredictable as day-to-day stock prices.
That's for sure. And you may hear a term called inverted yield curve. And if you look carefully at that black line, that front end of the black line on the left side is a tiny bit higher than the 30-year end. And it looks flat to us, but that in some ways is what people might call inverted yield curve.
Exactly. Not a good thing for economic growth. Yep. So our overall outlook right now is fairly positive, with earnings expectations being high and stock prices following. So we expect to see continued normal volatility, which, as we always say, is a 10 to 15% correction every 12 to 18 months. But definitely stand by, look for next quarter's market update, and we'll continue to keep you informed and up to date onto what we're looking at as an investment committee and our outlook for the future. So I hope you found this valuable. I encourage you to visit our website, johnmoore.com. Look at the top right corner at the Insights tab, where you can view other videos as well as our blog that we update at least monthly with financial planning topics as well as further economic information. As always, if you have any questions, please contact our office, and a John Moore Associates team member would be happy to chat with you.
And we want to thank you for the continued opportunity to serve you and your family.